All right, so in my first video of my stock basics video series, I would like to look at what exactly is an ETF. And an ETF is something that's very important to understand because essentially it is a basket of stocks that is traded on exchanges, right? So instead of having to go into, some fund somewhere to get your money managed by some professional at an investment bank or a private equity firm, you can just buy an ETF like PAVE here. Now, this ETF is specialized into holding a basket of stocks that focus on infrastructure and development, as you see here. So this could be companies like Nucor, Deere, any other company that makes construction equipment, concrete, anything that can go into developing this infrastructure, right? Now, different ETFs act very different. As you can see here, our dividend yield is 0.51%, which will mean every year at this price, if the dividend stays the same, we will be receiving 0.51% of what we have as value in our shares. So 0.51% of 2466. Now, ETFs vary wildly in their expense ratios, and an expense ratio is a premium you pay for your money to be actively managed in an ETF. So something like PAVE, where the money is being managed pretty well, it's getting moved around. It's not just a passive ETF, it's actively managed. They charge a 0.47% expense ratio, which means you're paying 0.47% of the stock per year. Right, so 0.47% of 2466 goes back to the people that are running the ETF. Now, as you can see, performance isn't too hot, but as a whole, the market isn't doing too hot either. So the point of getting into an ETF that is actively managed is to have your money be safer. It is to minimize the losses and maximize the gains. So you're trusting the professionals with your money to put your money in the perfect spots, right? Now let's look at something like VOO. This is the most popular ETF. It tracks the S&P 500. Let's go SPX real quick. As you can see, it's the exact same thing. Now, SPX is an index, so you can't directly invest into it, but with something that tracks it like the VOO, which has the same holdings as it, you can do that very easily. As you can see, your dividend yield is much higher, about 3 times. So you make 1.5% of 358 if you have a share. Now, the expense ratio on this is much lower than the last. It is at 0.03%, which means you pay 0.03% of the value, which is really quite great, as it's awesome to not lose your money to the people that are managing the fund. And this is allowed to do this because, one, Vanguard is massive. They have tons and tons and tons of assets under management, think in the trillions, wild amounts of money. And two, it's not very actively managed. The S&P 500 will change sometimes. A good example of this, a company that you guys might know about, is Lucid, which is a $30 billion market cap. So this is towards the bottom of the S&P 500, of course, as we have companies like Apple, who are worth 2.219 trillion, which is the biggest company in the stock market. Now, how the S&P 500 works, for example, the holdings are based on the market cap of the company. So Apple has about 73, 74 times more impact per percent movement on the ETF, which is why when companies like Apple, Microsoft, Amazon, Google, when they start going downhill because they're such massive companies, they bring the S&P 500 down with it, as those are some of the largest holdings. All right, so I like to look at the holdings of PAVE. So I like to do this to sort of visualize for you guys how weighting works. So Nucor is 4.26% of this ETF, PAVE, right? And as you can see, our 52-week change here, 12.43%. So 4.26% of 12.43% went towards this ETF's price movement. Now, if you go down here, look at something like Aztec Industries, which is only 0.22%, so a fifth of a percent of the ETF. It is performing very poorly, as we can see here. Now, That's awful, of course. You don't want any holdings that are doing that terrible for you, but it is very small. You'll need a 22% gain on Aztec Industries to equal a 1% gain on Nucor. And this is because of how weighting works, of course. And this is why ETFs are so awesome, because there's so many different ETFs that you could get into. There's one I just showed you, PAVE, infrastructure, development, construction. You can buy SP 500 tracking ETFs, VOO, SPY. There's tech, there's electric cars, there's solar energy, there's healthcare, there's anything you can think of, anything you want. If there's an industry you look at and say, I want to be in this industry, but I don't want to buy a specific stock, spend $30 and get 99 different stocks and have it be actively managed or passively managed if you don't want a high expense ratio. Have it just be the largest or whatever. That wraps up the video. Hope you guys enjoyed. Hope you learned something. Peace.